This is the Alternative Investing Advantage podcast from Advanta IRA, where we show you how to explore investments beyond Wall Street and open your eyes to new options for your portfolio. It's time to take control and give yourself the freedom to choose where you invest your money.
Welcome again to another edition of the Alternative Investing Advantage podcast. As always, my name is Alex Perny, and today we are very pleased to welcome on Ben Spiegel with Redwood Capital Advisors. He's the founder and CEO, and we're very excited to jump into the topic at hand today. We've covered a lot of different interesting topics, as everyone's aware on this podcast, everything from companies that invest in distressed properties to interesting alternatives. We've even had people that buy pennies on the dollar properties for meth lab remediated properties to all sorts of interesting things. But today we're going on maybe the more appealing end of that spectrum and talking about luxury RV space and how this is being packaged into things that are investment vehicles for people to make some pretty interesting returns. So been very excited to discuss this with you today. If you wouldn't mind, give us a little bit of background about yourself and kind of how you came to be in your current position with Redwood Capital.
Yeah, thanks so much for having me. I really appreciate it. So I graduated from Syracuse University in 2011. I went to work in investment banking at Barclays Capital and high yield capital markets for about a year. And then I moved over to the buy side, working at a couple different event-driven credit opportunities hedge funds. Lower middle market, leverage loans, high yield bonds, more of a generalist, so not with one really industry focus, more of a more looking at the underlying cash flows of a company rather than what industry it's in. I've invested in everything from companies that operate coal mines to tribal casinos to tugboats and dry barges. So I was on the buy side for about 5 or 6 years, and one of the better decisions I made was after 2 or 3 years in, when I started making a decent amount of money. I made a rule that I would always take half my bonus and buy a small property with it. And
Okay.
So I started buying very small multis, like 4 1 beds over a deli, right north of New York City. And over a period of 5, 6 years, I accumulated like 8 or 9 buildings when I got a call from Signature Bank, which doesn't exist anymore. They were a pretty predominant lender in the tri-state area, especially in New York. And they called me about a non-performing loan cross-collateralized by about 150 apartments across 10, 12 buildings, specifically in the 2 areas where I owned apartment buildings, Mount Vernon and Yonkers. And long story short, I ended up being entrepreneurial and decided to take out note-on-note financing and raise 5-6 million equity, take the note through bankruptcy, restructure it, and sell it. And that's when I started Redwood.
Okay. Yeah, it's always interesting to talk to people that come from the the more traditional finance side that it's like the interesting evolution of almost everyone in that space is that, you do all this stuff and then everyone kind of circles back to real estate in some form or fashion. It's always interesting. I talk to people, that sit on, trading desks and that do all sorts of crazy stuff that, get their CFA and then, I talk to them or they come to me for my services and they're like, yeah, let's do some real estate. I'm sick of all the wild swings and stuff. And yeah, it's just kind of interesting how that evolution always happens. So, yeah, definitely interesting trajectory. So how did that experience kind of color your kind of investment thesis with going into that, non-performing note after you had, started, acquiring some buildings in the tri-state area? How did that kind of, shape what you wanted to do with Redwood?
Yeah, so I learned from a very young age, operating always really in very illiquid asset classes, that not only is what you know important, but who you know is almost more important. That your relationships are, in a sense, your net worth. That if you don't have the counterparties to provide liquidity and deal flow to you, it doesn't matter how much you know. So, and what I also was great about working on the buy side is all the funds that I worked for were really more lower middle market special situations in that they invested across the capital structure, so in both debt and equity of only private companies that usually were undergoing some type of stress or were in stress or distress or going through a Chapter 11 bankruptcy or restructuring. So I got a lot of experience with just robust due diligence, really digging in deeper than the next guy, thousands of hours of due diligence on each company, a lot of which were hard asset or real estate heavy. And that's where I really learned that, or just I realized that number one, it's much better to kind of have an asset agnostic mentality in that most people in real estate really limit themselves to one or two asset, whether it's just multifamily, mixed use, or medical office. I go a step further from that, and not only investing in any type of multifamily, but I'll also do hard money loans or invest in lower middle market companies, both the debt or the equity. I find that I'm fortunate enough that I built up enough analytical skills that I can feel comfortable investing in anything as long as I'm able to get a good idea of the underlying dynamics of what's driving the cash flows.
Certainly, yeah. I mean, that's, we definitely kind of have some corollaries there. There's so much money to be made in the margins of any market, that so long as that you're willing to kind of do the work and dig in and look for it, there's value to be found everywhere. Just because something doesn't kind of have that big attractive marquee banner doesn't mean that there's not money to be made. A good example is kind of what we do on the professional side for our custodial and trust work. There's about $37 trillion worth of net asset value in retirement plans. Maybe only 4% of that is the alt space and what we do, but it still carves us out to have a firm that administers over $3 billion worth of assets. So, it's so long as you're willing to look and find that, there's so much money and so much value in some of these markets that you can find some really attractive opportunities.
I mean, I honestly think it's the only place to look. I'm a contrarian at heart. When everyone's running one way, I like to run the other. Um, I think that the following the herd mentality is flawed, and doing what's popular and loved will you'll never really be able to generate outsized returns. And that to really make outsized returns, you have to do what's sometimes seen as unpopular or unliked or shunned. A good example would be an investment that I made in Bowlmore AMF. I don't know if it's the largest bowling alley in the United States. They have 350 centers. AMF, before it merged with Bowlmore, was bankrupt. Nobody wanted to touch this bowling alley with a 10-foot pole. But upon doing a little bit of research and realizing that there were some interesting real estate dynamics in play, the firm I was working for, I was able to buy them, 5-7% of the equity at a post New York equity equivalent price of $5 a share, and 3 years later it was sold at 80. And coal mines as well. Everybody, because especially now institutions are not even allowed to invest in coal, but nobody really realizes that over 55% of electricity in the United States still comes from coal. Just unique kind of contrarian situations that I feel are the best for making the most attractive risk-adjusted returns.
Yeah, it's kind of the Wayne Huizenga mentality. It's there's not a whole lot of attractiveness in picking up garbage, or and when he was buying sports teams in the late '80s, as everyone was calling him crazy, and now there's a business school at University of Miami named after him. So again, the margins and the less sexy stuff definitely is where, you see people, making their billions. I mean, look to Jeff Bezos, it's like online bookstore operating at a loss for 15 years. All right, well, who's the fool now? So, we could probably opine on the benefits of looking in the, alternative, not only the alternative space, but just the alternative ways of looking at things. And again, that plays very well to, what we do here with our audience and also what we do with our clients. But I'm really excited to kind of dive into kind of what we had discussed previously to this in looking at the luxury RV space, because especially since, like leading up to COVID, at least from my limited understanding of it, it was kind of, again, if it was, underutilized then, the adoption of what people wanted when you kind of have the, digital nomad, as much as I don't necessarily like that term, I'm not a big kitsch term fan, but for lack of a better term, people that, said, hey, we're going to pack up and go on the road. And especially with that being very prevalent in, higher paying tech sectors and younger people, there's a lack of, market being served there. So again, let's kind of dive into kind of how you initially maybe identified that, what was kind of the key catalyst to saying, hey, look, there's not a whole lot of probably like available metrics that you can look at, like with your AMF one, there's not a whole lot of balance sheets you can go through and dig in and see, what the debt to equity ratios are, where your cash flows, your net asset values are. So how'd you kind of come to say like, hey, this is a really attractive opportunity that's being wholly underserved?
Yeah, well, just to jump right in, I mean, number one, there's a big stigma around RV or trailer parks. A lot of people just go straight to 8 Mile and they think of M&M and which is more of a mobile home park. But there's just a general stigma around the industry that the tenant's quality is poor. So I think that's one of the big kind of general factors in play that make people unattracted to the asset class. What really got me interested was in New York State in 2019, the state legislature passed some pretty arduous laws regarding rent stabilization and made it much more difficult to implement a multifamily value add strategy. And uh, I moved to Connecticut to start doing a lot of business here. But what I realized is that I couldn't just keep adding value to capital, that I needed to multiply it. And that was very difficult to do in multifamily when the business model was just very simple and everyone and their mother knew about it and really kind of how to get into it. So I was really seeking outsized returns in almost any different type of asset class, and it brought me on a huge type of due diligence tour. I started getting, I went down to the Southeast. I ended up investing in some mobile home parks, which I think are attractive investments. But that indirectly led me to the RV destination space. And once I started diving in pretty deep, some of the statistics I found about and the state of the industry I found were just remarkable in terms of how antiquated it is and how ripe for disruption it was. And it's just we'll get into it more, but it's pretty remarkable. I've never seen an industry with a greater supply demand imbalance where. I mean, even some of the larger operators, if you look at their logos, it looks like they were drawn by children. It just every
Yeah,
aspect of the industry is ripe for disruption, in my opinion.
yeah, the old Microsoft Paint clip art banners. But yeah, it's I wholly agree with you. Some of the most like outsized returns that I've seen, at least in my past 13 years of only being in the alt space, have come from the manufactured mobile home park space. A quick anecdote. One of the more interesting ones I saw is I had a client with his SEP IRA had bought a small trailer park near Lake Lanier in Georgia. It was 9 pads, and they were all massive. So he goes in, buys it for like a buck 20, replats it to triple the pad space. So he goes from 9 to 27, And then he had a friend that would do property cleanouts, and he was finding trailers. He'd bring them in, sell them. He would put them on the lot. Then he'd have people come in and rent them. Then he would sell the trailer on a retail installment contract. So then he would still own the underlying dirt. So he'd make the rent. He'd make the rent payments to own the trailer on that. Make payments on that. Then the foreclosure process in the state of Georgia on retail installments was really easy. It's like foreclosing on it's like repossessing a car. So he just kept churning and burning on that stuff. Got it fully stabilized, had everyone in there. I mean, from just the asset value of like, call it a, par value of $120 coming in like 3 or 4 years, I think he had that thing up to almost $1 million in a tax shelter. And just, from dealing with trailers in rural Georgia. So I like mobile homes. I think it's, I get real excited when people say that they kind of get an itch for it, because I'm fairly certain that, when you buy a mobile home, somewhere in there's like a machine that prints money.
Absolutely.
Somewhere in those things. I mean, the asset value to cash ratio on those things can be just astronomical. So,
I mean, I also think there's a lot of synergies. If you look at any publicly traded REIT that's in the RV space, it's not a coincidence that they're also in the mobile home park space as well.
Yeah. And that space is getting really saturated with the institutional money on like the bigger park aspect, when you start talking about like, 50, 60, 100, mobile homes in one. But, that's just, those things are, pretty adjacent to large metro areas. When you start getting out in the more rural communities, the institutional money, at least from what I see in my clients, really hasn't permeated out there. They just, they want something that is more adjacent to what they're used to in the commercial space, self-storage, commercial multifamily, light industrial. They want something that they can, say, okay, they draw the corollaries there. So whenever you start getting outside that bubble of like the large mobile home park, everything downstream, whether it's camping, whether it's, the small RV parks or just mobile homes on land, at least from the past, even pre-COVID up to now, I keep waiting for them to start getting into that space, but they aren't. So yeah, it's really interesting to see just how much of a blind eye they turn and how much opportunity is out there for people.
Yeah, I mean, one quick nomenclature I'll say on the mobile home parks before we move to the RV. I mean, there's just such a shortage of affordable housing out there right now. It's insane, and it's compounding year after year, and it doesn't take you don't have to be a rocket scientist to know that the average pad rent in the United States now probably about 275 over the next 5 years is going to be at 575, 600, and it's just going to keep continuing because there's just at the end of the day, from a permanent housing standpoint, there's not a more affordable option that offers the benefits that a mobile home does in terms of having a small yard. And a lot of them, if they're operated well, they're nice communities, and they just have the stigma like we were talking about, which drives a lot of people away. But if most professions, they can't afford $1,800 a month for a 2-bedroom or 3-bedroom right now. So it's just I'm a big advocate of any type of solid affordable housing play. In mobile homes, especially where you're not responsible for repairs and maintenance, which is a big aspect with the RV industry as well.
Yeah, and personally with my investments too, I really, I enjoy when I can do something that is, not only makes a good to an outsized return for myself, but also provides some type of good in the world. I mean, there's, again, to your point, if you build affordable housing and you go up, there's a certain level that you can build that to. And for the same amount of money for someone looking for affordable housing, if you can get over the stigma, mobile homes can be extremely nice. Like if people think of, like little 1950s, you got the front porch falling off and you got a washer and dryer in the front yard. They have that image, but if you've seen some of the stuff like we have, it's, you can get a 3-2 with nice finishes and a yard and a deck and, a paved driveway for a third the cost that you can get, something else that's affordable, and you can build equity. And again, you can, start going towards that quote, American dream of home ownership and everything like that. You just have to be okay with that. And again, people aren't, and it's sad from the affordable housing aspect, but it's also good from the investment aspect because it lets people that are interested in the space come in and, provide that value to the, to the the people that need it, and also to your portfolio as well. So again, we could probably opine on our opinions for that for the next hour, but let's start getting into
Yeah,
again what we want to talk
absolutely.
about in the RV space, because that's what I'm really interested in. Is that, I understand mobile homes probably better than most, but certainly not as good as a lot of people out there. But I really don't understand the RV space. Past my friends from, and I literally have in COVID, kind of the prototypical people. I have a friend that's an attorney for Google in their YouTube space, and another ad agency manager that literally in COVID bought a big RV, a new truck, and started going around the U.S. Like you couldn't make a more like again, a more kind of stereotypical one. I love them both to death. But again, that's, they were just doing that. And that's kind
It's
of the
funny you
marketing
say
for
that
that.
because I mean it's the typical tenant or resident or client short-term stay at our destinations now is not someone in their early 60s. That's a retiree. It's someone in their early 30s with 4 computer screens. That's an IT consultant,
Hmm.
and it's really remarkable. But so just to kind of I guess get us off and rolling, just some interesting statistics about the industry that are really mind blowing is. I mean, the average age of an RV buyer in the United States today is 32 years old. Um, about every year, about 450 to 500,000 new RVs are sold, but only 10,000 new pads are built. So
Hmm.
that's about 2% of new demand coming online annually. And like we were talking yesterday, the industry is so antiquated. 90% plus of existing destinations are over 45 years old and are run by single owner mom and pop operators that don't have the capital or the wherewithal to even really think about upgrading their destinations to the level that the new cohort or new demographic of millennial really wants to see in a destination that they're really going to be comfortable spending time in. And when finally you top that off with COVID, which was the rocket fuel, now with 35% plus of permanent office workers now pretty much permanently remote, it just created the perfect storm for the industry to just take off in ways like nobody could have imagined.
Yeah, no, and the primer for that's definitely interesting. I definitely wouldn't have thought that the average age for the RV buyer would have been so young. I would have probably pegged it in the early 40s, but saying that it's that young is definitely interesting. Because being that in 32 is a few years younger than me, but only being 35, I can definitely identify with that particular kind of, culture of people. And it's surprising that the supply of where to, kind of, again, put these things and utilize them and enjoy them is being outstripped by demand so much. So let's kind of identify, the operators of these things and kind of where you identify value. So, there's not a whole lot or any new ones coming online, right? So, when you look at these things, like if you're coming in and saying, okay, you're looking at these mom and pop shops, what are they actually offering? And where are you kind of doing that value add in this space?
Okay, so the bar is very, very low. And just because, like we were saying before, because the demand has so far outstripped supply, I've never seen a supply demand imbalance like this in any industry I've ever analyzed in my entire career. That basically, even though these mom and pops are not really investing anything into their spaces, to their destinations, uh, they're still pretty much full. And so, it's really it's kind of perpetuating that inefficiency. But what I've found is if you're able to create a slightly differentiated offering, and by slightly I mean literally just keeping your place clean, safe, quiet, offering and having good wireless internet connection, and potentially a pool of any quality, if you're able to just simply offer those things, you are going to be able to charge a 50% premium to the comps within a 10-mile radius, and your forward occupancy rate is going to be 75% or 80% or higher. just by all and taking like a taking being having a good website and having a software where you could take online reservations. Like I was saying, over 70% of destinations still do not take online reservations. It's phone call only.
Oh, wow. So when it comes to kind of, again, that's, and I would imagine that the kind of the issues in the asset class are pretty pervasive. I mean, you probably don't see much of like a spread on that. Like every single one of them probably has the same issues of like no or bad Wi-Fi, like no real online presence, and just like the basic amenities aren't there. So again, if you find one, it's kind of basically like that. Now, are you only looking at the acquisition reposition, or are you looking at kind of the development play, as you will? Again, I mean, there's not a whole lot of development that goes into buying a piece of land and converting it into that, but where's kind of the main marker that you look for? Which of those two buckets, or is it a mixture?
So it's really a mixture. Everything is a special situation, but there's really two different types of RV destinations. So you have communities and resorts. Okay, so a resort is going to be on the beach, or it's going to be next to Disney World. It's going to be next to a major metro, or on some type of water, have some major attraction, and it usually is going to have more amenities. But at the same time, your average stay is probably only 2 to 5 days max. So you have much higher turnover, and because you have all these amenities, your OpEx is higher, your operating expenses are higher, and also one of the largest hurdles or problems in this industry is securing good human capital or good employees. And really, because at the end of the day, people don't realize that even though it's a real estate investment, you're in the hospitality business to a certain extent, and you have to be able to offer a level of service that people appreciate. Because if you can't hire good people, especially if you're not on site, it's going to affect your organization in a negative way over time, dramatically. But so you have the resorts, which are like I'm building one right now, actually, in Long Beach, Mississippi. Basically, what I found was that in my research was that Texas and Florida were already pretty saturated. Not saying you can't find a good opportunity there, but there was already a large institutional presence, and I found that in Mobile County, Alabama, and Harrison County, Mississippi, were probably the two most attractive markets with the dramatic lack of institutional presence, where you can build economies of scale pretty quickly, and because that's also a big part of success in this industry. You have to build a certain level of economies of scale to be able to weather the seasonality of the business. But just finishing on what I was saying earlier, so you have the resorts, and then you have communities, which I almost like a little bit more. So the communities are probably like 40 minutes in from the beach, or they could be in the middle of nowhere. And there you're targeting maybe more migrant workers, or even millennials. But your average you're getting probably about between a 30 and a 50% discount on an average daily rate basis, but your average stay is usually between 75 and 90 days. So your turnover is much less. And because your turnover is much less, your management expense in terms of how many people you need to run it is much less. So you're talking about with a community, you're probably looking at I would use a vacancy rate of about maybe 10 to 15, 20% max, and then uh, you'll operate at a margin of 65%, as opposed to a resort. You're looking at a vacancy rate average of about 30%, and then no higher than a 45 or 50% margin on top of that.
Got you. So what would be like the just the difference in like your operating expense ratio between like the more resort oriented ones and again the ones that are a little bit more rural? Like what would be kind of the delta between those two?
So I'd say you need half. You're going to need half the workers. You're going to need half the people working there at a resort versus at a community. Uh, Usually, my rule of thumb is per 40 pads at a community, you need one worker for
Okay.
one, and it's double that at a resort.
Gotcha. And like between the two of them, which one has kind of the more abundant like acquisition reposition versus the one that you have to do more of a development play on?
So I'd say the resorts are much more of the development play versus the communities are much more of the acquisition, restructure, reposition. Because also, even if you have a mom and pop operator that's operating, I guess we would call it like a community style destination, but in a resort style location, when they go to sell, the price that they're going to be getting is based on the underlying land, and it's going to be triple or quadruple what it would be if it was in a location that was better for a community. And I mean, the communities, there's still several criteria that you have to be very close to a couple major highways. I have a big rule of thumb: you have to be within 10 miles of a Walmart supercenter.
Hmm.
That's a general rule of thumb for me. Bank, restaurants, but that's really about it. I have one in Mobile, Alabama, and in Theodore, and when you drive literally 30 seconds out of the RV destination, you go to the restaurant down the street, it'll take them 5 minutes to process your credit card in terms of that's how bad the internet quality is.
Oh wow.
But when we bought that and repositioned it like 4 or 5 years ago, the average so on the communities you're also charging usually on a monthly rate versus a weekly or a daily, and everyone thought we were crazy when we said we're going to get $1,000 a month because all the comps were getting between 4 and 550, but we just knew that if we could, like I said, just op- operated decently with clean, safe, quiet, good Wi-Fi, and a pool, that we would be and to take online reservations, and that would be enough of a competitive differentiator to get us to the level where we needed to be. And our prepaid 12-month go forward occupancy rate there is about 85%.
Yeah, and I would imagine that kind of also plays into, again, the changing market structure where maybe pre-COVID you had everyone treating these more as like, oh, it's a vacation or a trip as opposed to, hey, this is my home and I'm just treating this more as a rent payment. So that psychological shift maybe in the marketplace being underutilized by saying, hey, look, like, as long as we meet the very, and again, I'm just saying this as a general term, meet the very low standard of what these people are expecting. And again, not to disparage anything, but it's not like necessarily like a high bar. You don't need to have like a masseuse and like, a steam room and stuff like that. You
It's
just
not
need
the
to get,
Four Seasons.
yeah, it's not the Four Seasons, but at the same time, they have a minimal expectation where they're treating it more as like a rent payment. Hey, I'm dragging my home now to somewhere as opposed to, hey, this is just a vacation. So going from that $400 per customer, per month, cash flow to $1,000 a month, while, yes, you are over doubling your, expense to the end user, psychologically, I still think that these people are still thinking they're getting a good deal
On a
because,
relative value
yeah,
basis, it's extremely low, and it really goes back to what I touched on with you yesterday. That for the first time in history, millennials are the first generation that have really done away with buying a home being the absolute end game for them. That's the end all be all. I just want to get married and I want to buy a home, and then I'm set. And then I'll figure. It's just for the first time, millennials are starting to value experiences more than that large materialistic purchase that they know is. I mean, also, in conjunction with rates being at 7.5% and the average price of a single family home going from 280 to 400 in the past 4 years. I mean, that doesn't help either. But it's just people, they don't want to be tied down anymore, and it's COVID had a big effect with that. People just they want to be free, and they want to be free to go wherever they want when they want. And now that they're not tied to an office, it's a very different way of thinking, and I think it's still evolving. And this is not a cyclical shift. In that it's structural. I believe that this is a permanent change, and we're not going back to where we were before.
No, absolutely. And I think a lot of this makes sense. And again, one of my favorite things about real estate is, again, like you said, it's not rocket science. It's really easy to kind of understand at a high level. And again, certainly with any investment, yeah, you need to know what you're doing. You need to know how to identify risk, how to buy right, how to operate right. And, that kind of stuff is not it's not, easy to do. You have to have a sharp mind and be able to navigate that. But at a high level, okay, yes, people don't homes are expensive. Younger people like to travel. They like experiences more than this. Where are they being underserved? And this is definitely a big part of that. So again, I think that's, again, between the difference between the communities and the resorts, again, being next to a Disney World or, a big casino community, or again, something that people want to do, Redwood National Forest, again, I think that's kind of the easy one versus the communities, which maybe are more local to maybe an industry that has a lot of people. I'd imagine things like, oil field workers and pipeline workers that, make a lot of money, don't want to be sitting in a dirt lot. They're like, look, I make 200 grand a year working on this pipeline. Maybe I don't want to be, next to, insert anything that you don't want to be
Or a
next to.
long haul trucker,
Yeah.
or like in Mobile, you're just seeing a tremendous amount of industrial growth. Amazon Supercenter, just Boeing, Airbus, just huge companies are opening huge manufacturing and distribution facilities there, and it's going to continue. I mean, Mobile is my favorite place in the country for the community play.
Okay.
And I feel that, like, we just went into contract on another a hundred pad destination about 10 minutes away from our other one, and and it comes with the zoning approval to build another 85 pads on it. So that one's it's unique because it's a little bit of I guess a little bit hybrid of restructure and develop simultaneously. But you have to realize that like you said, in terms of construction, you're dredging, you're laying plumbing, and you're pouring concrete. I mean, the biggest cost is related to the topography and moving the earth. But I mean, all in, you're looking at maybe 30 for an average facility, average estimate. You're looking at probably about 30 to 32,000 a pad. And in terms of an ROIC, you're over 20%.
Yeah, I
Just
mean,
on
if
a
you're
free
talking
cash
about
flow standpoint.
$1,000 a month potential return, so long as you can keep, again, so long as you can keep that the occupancy up, which it sounds like it definitely is, not the craziest thing to do, especially once you have such a huge delta between the offering that you're doing and what's currently in the market. It's the math is really easy for $1,000 a month on a $30,000 like development cost per pad. I think anyone that's looking at that at a high level thinks that, oh, that's nice, considering, if you want $1,000 a month and you bought a mobile home and we're doing that same play, you might be into that acquisition cost for, $120 to 200,000. So again, the number is definitely the maths on that.
No,
So
absolutely. Simple is
yeah,
good. And
yeah,
that's another reason why I got into the RV space, because uh, I've been lucky in that I've developed great relationships, and I've always deal flow has never really been my problem. I've always been able to stumble across off market owner direct special situations that are really solid despite the interest rate or the market overall. But the desire for multifamily investing has dried up to a certain extent. And anytime you go into an institution or high net worth individual and you start talking about the RV space, it's apples and oranges. There is just such a large, because it's a niche offering. It's very difficult to get exposure to, and especially with an operator that has a proven track record. And another really important thing about the RV industry is, in my opinion, is you have to be in a favorable climate. You have, like, doing it in the north where it snows, where there's even more seasonality. I mean, people make it work, but that's not for me. I have a hard enough time making it work in the South when the seasonality is, really during the slow time is during the summer.
Mhm.
Um,
Yeah, it's sitting down here in Florida right now. It's many things, but hot it is always. It is boiling hot. It's a little overcast today, which is nice, but that means it's only going to be 88 degrees instead of 95. So,
It's
um,
interesting though, but I'd say like one of the more interesting is like we're out at this unique inflection point where the demand and the supply is so imbalanced that you're like right now in Long Beach, I'm doing an ultra luxury deeded condo lot development
mhm.
where I am I'm just about closed on 22 acres on the beach, and I am going to be building about 150 pads, and I'm planning on selling them for about 250,000 a pop versus my all-in cost and give mind you these are much larger pads. They have pergolas, they have outdoor grills, private hot tubs. You're probably about 80,000 a pad, but I mean, and then I'm paying 5 million for the whatever. So all in, I'm at about 110 per pad, full all in. But I mean, just the fact that you could sell a tenth of an acre for $250,000 is pretty remarkable. And
No, absolutely. And that kind of leads me into, the next thing I want to talk about is, um, and it kind of plays into the whole aspect of, people know and understand commercial real estate. Banks understand it. People with money understand it. So when it comes to the acquisition and financing of this, is that kind of a bottleneck in this? Because it's, explaining to a lender or an investor saying, hey, look, here's commercial multifamily. Here's the doors. The metrics are there. People, people literally write books about it. There's a ton of them. But in the space being so new, when it comes to the acquisition of this, is it something that you have to do more education to the people, or is like how apparent is the value play in this when it comes to actually acquiring the acquisition debt to do this? So I'm assuming I don't want to make an assumption, but I would assume you're kind of doing this more traditionally where you find it, you finance it, you have terms, you have an exit strategy. So,
of course.
what does that look like for your
So,
position?
so for a new development in particular, so I mean, on a deal like this one, I seller note on the land. Also, we'll be taking out a construction loan. I'm looking probably about a $7 million equity raise. So the land's 5 million, 1.25 down payment, 3.75 seller note, payable in 3.5 years. I'm going to be probably getting around 9 million of construction financing and raising another like 6 or 7 of equity. And usually the lenders they'll do construction to perm. So the construction process. One of the reasons why I love Mississippi is it's very business friendly, even as opposed to Alabama, where from the time you get your site plan done to the time you're putting a shovel in the ground could be 18 months later. In Mississippi, from the time I get my site plan to the time I'm opening is 7 or 8 months later.
Oh, wow.
Yeah, it's pretty remarkable. And so you have to establish anywhere it comes down to relationships. You have to get familiar with certain institutions, but like Emeritus Bank is one of them. There's a few specialty banks out there that do the construction to perm financing.
Gotcha.
And one for people just on the smaller side starting out, like a lot of like one of the resources that's not really widely talked about, but it's tremendously favorable, is either SBA or U.S. Department of Agriculture financing. They both will lend to build or to buy one of these an RV destination. So that would be my recommendation to most.
Okay, gotcha. Yeah, and that's pretty interesting that the owner financing seems to be a more popular option because, at least again from that more traditional kind of institutional finance, you're kind of, breaking it up with, a dual note structure with having, the owner financing on the land and then doing construction. I think the construction play on that's probably a little bit easier for people to understand. It's like, hey, I need construction, and then, saying, hey, let's do this,
Well,
construction to
it's
perm.
not as easy as it sounds because you'll always run into the subordination issue, and the seller does not want the note to be subordinated to the construction financing, and the construction financing doesn't want any subordinated debt below. So it's always a little bit of a balancing act. And with new, like, if you're like building a new community, like the problem you'll run into is I was building 300 pads in Mobile. We were buying, 30 acres for $1 million, and the development budget was 12 million.
Hmm.
So, I mean, think about it. Like a bridge lender right now on land isn't giving you more than a 65% loan to value. On something like this, like forget loan to value. You're at multiples of the value of the land on your development cost, and so that makes it difficult from a lending standpoint, and that's usually why in those circumstances you have to go to the U.S. Department of Agriculture or the SBA
Okay.
for those types of circumstances. But if it, like what you have going for you in the Southeast right now is in conjunction with record high interest rates is you have the crazy insurance market. Is insurance rates have been doubling. So any project that was feasible even like a year and a half 2 years ago, multi self-storage, is not feasible anymore. And the only type of project that is feasible is really an RV development, because if it does flood, at the end of the day, it, it's not the end of the world. Yeah, I mean, your landscaping is ruined, but you have insurance. But like, it's just concrete paths. Obviously, the more luxury developments where you maybe have some other structures, yeah. But at the end, it's really you have that kind of play going for you as well. That building anything else just really isn't feasible, and there's not a lot of people that are well versed in building these. So you have a lot of developers that, I mean, I look at pieces of land all the time that had approved plans for large multifamily developments or large self-storage projects, and it's been on they've been on the market for 2 years, and they just because it's just unfeasible to build right now anything else down there.
Yeah, no, absolutely. It's I literally lived through that. It's the insurance markets down here are absolutely bonkers. We'll see what they actually come up with, but it is absolutely insane. So, the understanding of kind of how these things again come together, we've kind of gone, almost full term with this. Now, what's kind of the exit strategy for this? Are you looking to then in turn refi to more permanent debt, get rid of everything, and then just hold for cash flow? Or are you looking to position these things for an exit like sale?
Yeah, so with the condo sales, they're very unique in that what you do is you'll sell you partner with a local bank that provides 80% LTV mortgage to the condo buyer. So if it's 250, they're only putting down 50, and they're financing the other 200. But and also what they're doing is what you're doing is basically they're allowed to rent it out because they're only going to be down there max 2-3 months out of the year, and then what are they going to do with it for the 9-10 months that it's sitting vacant? They want to generate passive income, so you allow them to rent it out, but of course exclusively through you at
Hmm.
a 70-30 split to them. So you're with the condo is such a unique strategy in that you're able to get sometimes 5 to 7x cash out within 12 to 18 months, and then a stream of cash flow for forever, an annuity type play. But those are very kind of more one-off special situations. I'd say my bigger strategy is to accumulate. So I'm actually about to go into contract on 1,200 pads in Alabama, Tennessee, and Mississippi, off market. It's going to be one of the larger off market deals in the space. And when I'm finished restructuring those, repositioning them in about 18 to 24 months from now, rates will come down. Anything you buy now you should really consider an interest arbitrage play, because rates will go down at least a little bit from where they are now. I mean, I've been saying for years that it's just a matter of time before the Hiltons and the Marriotts own the vast majority of this industry. And ironically, about 2 months ago, Hilton came out and announced that they're entering the industry through a partnership with AutoCamp. So my plan is to monetize a bulk sale to a Brookfield or a Hilton in 3 to 4 years. And I'm actually I'm just about to top off raising a $50 million fund to do that with.
Awesome. Fantastic. Well, I think that kind of brings us to a good conclusion on the stack in this space. It's been very interesting to talk to you about it. I always enjoy when I can do these and actually learn something along the way. Not that I'm a subject matter in anything to the point where I can't learn anything, but being in the alt space for as long as I have, I know a lot about a lot of things. But seeing something that's wholly new to really kind of dig in and learn about is always very enjoyable. So,
you should remember why Florida is the most interesting state, but I'll leave you with this, is it's one of the only states in the country where you're allowed to use escrow dollars as equity. So if you were going to do an RV condo development and so you could sell pre-construction, you could use that money as equity.
Learn something new about the great state of Florida every day. But yeah, so if people are interested in learning more about what you have going on, or if you have potential investment opportunities, what's the best way for them to get in touch with you?
Yeah, my website's redwoodcapitaladvisors.com. I'm on LinkedIn, and my Instagram is Redwood Capital ADV.
All right, fantastic. Well, Ben, thank you very much for being on with us today. As corny as it sounds, our most valuable asset we all have is our time. So thank you for spending a few of your human capital hours on our podcast today. We really appreciate it. With that said, this has been the Alternative Investing Advantage podcast. My name is Alex Perny. As always, thanks and have a great day.
Thank you for tuning in to the Alternative Investing Advantage podcast. Tune in next week for more investing tips and strategies.
Want to hear more episodes of the Alternative Investing Advantage? Search podcast at advantaira.com and subscribe.